Indexes, ETFs, index funds, mutual funds. You might have heard these terms before, but are you unsure what they mean? I'm going to take a look at that in this video today. So guys, like all my other videos, timestamps and chapters will be posted right here and along the timeline. You'll also find them in the description, and I'll pin them in the top comment. And guys, just one more note. All these videos are transcribed into written format and can be found on my website at mratal.com. I'll post a hyperlink into the description, so if you feel like the video is going too fast or you prefer to have like a paused or static view of certain or specific information, you can find it all on my website. So if you don't like pausing videos, a website is a great alternative. So once again, it's mratal.com, and I'll have a link of that in the description. An index is a method to track a group of assets. Assets can include companies and/or securities. Indexes can include broad markets, such as the S&P 500 and Dow Jones, or specialized indexes for particular market segments or industries. Indexes are created to track financial or economic data, such as interest rates, inflation, or manufacturing output. Indexes serve as a benchmark to evaluate the performance of a portfolio's return. A popular investment strategy is to try and replicate an index in a passive manner rather than trying to outperform it. Each index related to its stocks has its own calculations. In most cases, the relative change of an index is far more important than the actual numeric value representing it. Indexing is a very popular strategy used by investors in passive portfolio management. Instead of picking stocks and timing the market, a manager will build a portfolio to mirror the index. The methodology behind this is that by mirroring the index, the fund will match its performance as well. Some popular indexes that can be found worldwide are the S&P 500, the Dow Jones, and the Nasdaq, all three of which can be found in the USA. You also have the DAX, which is a German index, as well as the FTSE 1000, which is from the UK. An index fund is a type of mutual fund or exchange-traded fund, also known as an ETF, that holds specific securities to that of an index with the primary goal of matching its performance. The S&P 500 is probably the most well-known index globally, but as shown previously, there are different indexes worldwide for nearly every market and investment strategy you can think of. A mutual fund is a type of investment vehicle consisting of portfolio stocks, bonds, and securities. Mutual funds give small or individual investors access to diversified, professionally managed portfolios at a low price. Mutual funds are divided into several kinds of categories representing the kinds of securities they invest in, their investment objectives, and the type of returns that they seek. Mutual funds are subject to annual fees, and in some cases, commission, which can affect the overall returns. The overwhelming majority of money in employer-sponsored retirement plans go into mutual funds. Guys, I'll make a more in-depth video of what a mutual fund is, but I'll also be explaining why I prefer not to use them and why ETFs are my preferred choice as an investment vehicle. An exchange-traded fund, also known as an ETF, is a basket of securities that trade on an exchange just like a stock. ETF share prices fluctuate all day as an ETF is bought and sold. This is different from mutual funds that only trade once a day after the market closes. ETFs can contain all types of investments including stocks, commodities, or bonds. Some offer US only holdings while others offer international. ETFs offer low expense ratios and fewer broker commissions than buying the stocks individually. The most obvious advantage of index funds is their passive nature and that they have consistently beaten other types of funds in terms of total return. The passive nature of index funds means that you will have much lower management fees than other funds. Instead of having someone actively trading, readjusting your portfolio, and researching teams analyzing stocks and making recommendations, the fund simply mimics the index. Warren Buffett once wrote to his investors that huge institutional investors, viewed as a group, have long underperformed the unsophisticated index fund investor who simply sits tight for decades. A major reason has been fees. Many institutions pay substantial sums to consultants who in turn recommend high fee managers, and that is a fool's game. Like any other stock or security, the value of an index fund will rise or fall based on how the index is performing, so the holder is subject to risk. While there are incredible benefits to having passively managed index funds, sometimes expertise in certain actively managed funds can outperform the market and create large returns on investment. Also, while diversification hedges against market volatility, the broad market index funds are often dragged down by underperforming stocks in the market. While the index might still grow in value, it will not grow at the rate of the best performing stocks or securities in that index. So in summary, some of the pros and cons of index funds are: index funds have very low fees, low tax exposure, passive management tends to outperform over time, and index funds provide broad diversification. Some of the cons of index funds is that there's no downside protection, they don't take advantage of opportunities, they cannot trim underperformers, and they lack professional portfolio management. Index funds can be purchased from brokerage or directly from the fund provider themselves. In Canada, some of the most popular stockbrokers are Questrade, Wealthsimple, and TD Direct Investing. I'll make a video on the best stockbrokers you can choose from and which ones I personally use. The most popular index fund providers in North America are Vanguard and BlackRock. These providers are referred to as registered investment advisors. Different advisors offer different products based on the region, market, and risk you're interested in. It is always best to compare the different options available, review the fees associated with their products, and understand where your money is actually being invested. I'll be making an entire video on its own evaluating and comparing the different ETFs and index funds offered by some of the most popular investment advisors in North America and which ones I personally invest in right now. Some of the key takeaways from this video are that index investing has seen a massive rise in popularity over the past decade, with billions of dollars of investor money pouring into index mutual funds and ETFs. Indexing is a passive investment strategy that seeks to replicate an index and match its performance, rather than trying to actively pick stocks and beat the index's benchmark. Index investing features lower fees, greater tax efficiency, and broad diversification. Research shows that over a long run, passive indexing strategies tend to outperform their active counterparts. Hey guys, if you really enjoyed this video, please don't forget to hit the like button and subscribe, and make sure you hit the notification bell so you get notified every time a new video is posted. Thanks everyone.